Welcome to this session of ACCA Academy lecture on IAS 1, presentation of financial statements. In this tutorial, I want to provide solution to a question from the past examinations of Chartered Accountants of Ireland. So, on request by one of my international students. So, the following standards are examined in the question I'm about to solve in this video. Number one, we have IAS 16. IAS 16, property, plant and equipment. Property, plant, and equipment. 2, IFRS 5, non-current assets. Non-current assets held for sales, and discontinued operations. Number 3, we have IFRS 16, leases. Number 4, IAS 12, income tax. Number 5, IFRS 2, share-based payment. Share-based payments. And IAS 21, the effect of changes in foreign exchange rates. Let's go into it. You are the financial accountant to Lease PLC, Lease, a manufacturing company based in Ireland. You have been presented with a draft trial balance and a list of outstanding items which may have an impact on the financial statements. These are outlined in Appendix 1. You have been tasked with finalizing the statement of profit or loss and other comprehensive income for the year ended 31st December 2005 and the statement of financial position as at that date. The finance director of Lease impresses upon you that all of your workings in preparing the financial statements should be clearly shown and has requested that journal adjustments are clearly provided. Question 1. Prepare the statement of profit or loss and other comprehensive income of Lease for the year ended 31st December 2005 and a statement of financial position as at that date. Appendix 1. Draft trial balance of Lease as at 31st December 2005. We have the debit and the credit side, amount in €1,000. Land at 1st of January 2XS5, 12,500. Building at 1st of January 2XS5, 17,600. Building accumulated depreciation at 1st of January 2XS5, 440. Plant and equipment at cost, 10,000. Plant and equipment accumulated depreciation at 1st of January 2XS5, 3,600. Intangible assets, 2.9 million. Inventories at 31st of December 2XS5, 4,120,000. Trade and other receivables, 3,860,000. No, there are triple zeros at the top. So cash and cash equivalents, 260,000. Then we have revenue, 46,960,000. Cost of sales, 28,280,000. Distribution cost, 3,630,000. Administrative expenses, 6,080,000. Other expenses, 1,390,000. Finance cost, 200,000. Income tax expense, 550,000. Ordinary share capital, €1, 2 million. Share premium, 3,680,000. Retained earnings at 1st of January 2SS5, 22,017,000. Revaluation surplus at 1st of January 2SS5, 1,870,000. Long-term borrowings, 4 million euro. Deferred tax liabilities at 1st of January 2SS5, 1,150,000. Trade and other payables, 4,750,000. Current tax payables, 550,000. Total of both the debit and credit side is 91,070,000. Outstanding items. Note, unless specifically stated otherwise, it should be assumed that no entry has been made in relation to the outstanding items below. 1. Depreciation should be calculated as follows. Building straight line basis to a nil residual value. Plant and equipment 20% reducing balance basis. Depreciation of buildings should be included in other expenses and depreciation of plant and equipment included in cost of sales. Linear applies the revaluation model to its land and buildings. The revaluation surplus in the trial balance relates to the last revaluation of land and building, net of deferred tax of 15%. This revaluation took place on 31st December 2003, when the building were assessed to have a remaining useful life of 40 years. At 31st December 2005, the land and buildings were professionally assessed to have a fair value of 32 million euro, including 13.2 million euro in respect of land. No land and buildings were acquired or disposed of during the year. Note 2. The plant and equipment comprises solely specialized plant and equipment, which was purchased on 1st of January 2SS3. On October 1st, 2SS5, the criteria were met to classify some underperforming plant and equipment with an original cost of 2 million euro as a non-current asset held for sale. At that day, the fair value of the underperforming plant and equipment was estimated at 900,000 euro and selling cost estimated at 200,000 euro. At 31st December 2SS5, Line's management is confident that the plant and equipment will be sold within the 3 months at its estimated fair value. No other plant and equipment was acquired or disposed of during the year. Note 3. On 5th of December 2005, Line purchased inventory on credit from a new supplier who is located abroad for 5.8 million FIARES. The currency of the foreign supplier. Line correctly recorded the transaction at the exchange rate on the date of purchase. The payable had not yet been settled at 31st December 2SS5, and the goods remained in the warehouse of Line. Relevant exchange rates are, we had euro to FIA, 5th December 2SS5, 1 to 4, 31st December 2SS5, 1 to 5. It is the policies of Line to recognize any foreign exchange differences as other income or other expenses as appropriate. Note 4. On 1st of November 2005, Line entered a 12-month contract to lease some additional warehouse space to meet short-term capacity issues. Line's directors elected to account for this as a short-term lease in accordance with IFRS 16 leases. The lease agreement requires a payment of 720,000 euro on 1st of November 2005 and on 1st of May 2006. The 1st of November 2005 payment was charged to cost of sales. Note 5. On 1st of January 2005, Line granted 40,000 share appreciation rights to each of its 8 directors, conditional in each case on the directors working for Line until 31st December 2007. Each share appreciation right had a fair value of 5.40 euro on 1st of January 2005 and 6.50 euro on 31st December 2005. Linen initially estimated that 7 of these 8 directors will still be working for Linen on 31st December 2007, but adjusted the estimate to 6 directors at 31st December 2005. None of the directors had left by 31st December 2005. Linen's accounting policy is to recognize share-based expenses in administrative expenses. Note 6. At 31st December 2005, Linen determined that the carrying amount of its net asset after accounting for adjustments from the information above exceeds their tax base by 12.8 million euro, with the exception of any deferred tax adjustments relating to the revaluation of the land and buildings in Note 1. The remainder of the movement of the deferred tax liability should be reflected in profit or loss. Linen tax rate is 15%. Solution to the question. The name of the entity is Linen. So we have statement of profit or loss and other comprehensive income. For the year ended. Ended 31st December 2xs5. So amount is in 1,000 euro. The first item will be revenue. And if you go through the trial balance, revenue amounted to 46,960,000. We have revenue of 46,960,000. After revenue, the next item will be cost of sales. Cost of sales. Let me have that as note 1. Note 1. So we want to show the calculation of our cost of sales. Note 1. Cost of sales. So we have cost of sales as per trial balance. Trial balance. TB, trial balance. Now, let's go through the trial balance. You have the cost of sales to be 28,280,000. 28,280,000. Let's go through the outstanding items. Note 1. Depreciation should be calculated as follows. Building. You have to use straight line basis to a new residual value. You have to use straight line for buildings. Then, plant and equipment, you have to use 20% rate, but reducing balance basis is to be used. Depreciation of building should be included in other operating expenses. So that means the depreciation of building will not be included in the cost of sales, but in other operating expenses. And depreciation of plant and equipment included in cost of sales. The depreciation on plant and equipment now, depreciation of depreciation on plant and equipment. You are to include that on cost of sales. Remember, reducing balance method is to be used for depreciation on plant and equipment, and the rate of depreciation is 20%. So, and that depreciation is to be included in the cost of sales. Now, Linen applies revaluation model to its land and building. We are not concerned with land and building, since land and building depreciation will not be included in cost of sales. So, this revaluation, that is still revaluation on land and building. Every other information given in note 1 relates to the land and building. The plant and equipment comprises, that is note 2, solely specialized plant and equipment, which was purchased on 1st of January 2003. On October 1st, 2005, the criteria were met to classify some underperforming plant and equipment with an original cost of 2 million euro as a non-current asset. Non-current asset held for sale. So remember, a plant and machinery which was acquired on 1st of January 2003. You were told the criteria for held for sale were met on 1st of October 2005. It had been acquired on 1st of January 2003. That means from January 2003 to December 2003 is 1 year of its life. January 2004 to December 2004, that is the 2nd year of the life of that specialized plant and equipment. Then in the 3rd year, from January to September 30, since the criteria were met in October 1st to XX5. So that means January 2005 to September 2005, which is a period of 9 months, it have not been classified as held for sale. The depreciation for X3, X4, and 9 months in X5 will be charged before the criteria for held for sale were met in accordance with the provisions in IFRS number 5. Non-current asset held for sales and discontinued operation. At that date, the fair value of the underperforming plant and equipment was estimated at 900,000. So at the day the criteria for held for sale were met, so it now have a fair value of 900,000, and the selling cost estimated at 200,000. Remember, depreciation of plant and equipment, you have to classify that depreciation as part of the cost of sales. Now, let's first of all calculate the depreciation on plant and equipment held for sale. Working number 1. So, plant and equipment held for sale. You want to determine the carrying amount of plant and equipment held for sale before the criteria for held for sale were met. Remember, the criteria were met on October 1st to XX5 in note 2. So you have the cost of underperforming plant and equipment. This is the cost as at 20x as at 2xs3. So January 1st, 2xs3, you have the cost. The cost of underperforming plant and equipment was 2 million as at 1st of January 2xs3. So depreciation that will be charged for the year. Remember, the depreciation rate is 20% from note 1 on plant and equipment. You have to use reducing balance method. 20% of 2 million. So 20% of 2 million, that gives us 400,000. If you subtract 400,000 from 2 million, then you'll be left with 1.6 million. This 1.6 million is the carrying amount as at December 31st, 20x3. This is the carrying amount as at 31st of December, 20x3. After 2x3, we have two XX4. So as at December 31st, 2SS4, depreciation will be charged as an expense, which is 20% of 1.6 million. That gives us 20% of 1.6. That gives us 320,000. If you remove 320,000 from 1.6 million, then you have 1,280,000. This is the carrying amount of the specialized equipment as at December 31st, 2SS4. Then we have 2XX5. 2XX5. So we have December 31st, you have depreciation, 20% of 1,280 times 9 months. Why not September 30 or October 1st here? Depreciation is usually charged at the end of the year, not the midway towards the year end. We normally charge depreciation at the year end. That is why, you know, the criteria for held for sale were met on October 1st to SS5. So that means depreciation for 1st of January, S5 to September 30, X5, which is 9 months depreciation, that will be charged. So we are charging depreciation for this 9 months period since criteria for held for sale were met on October 1st to XX5. So that 9 months depreciation gives us 20% of 1,280 times 9 divided by 12. That gives us 192. That is the depreciation that will be charged in the year. If you subtract that depreciation from 1,280, then you have the carrying amount to be 1,088. Carrying amount 1,088. That is carrying amount as at December 31st to that is the carrying amount as at the year end, or as at the date the criteria for held for sale were met. This carrying amount will now be compared with the net realizable value in order to know if this asset has been impaired or not. So the accumulated depreciation, before the criteria for held for sale, criteria for held for sale were met. Before the criteria for held for sale were met, the first year of this asset, depreciation of 400 was charged. 400,000 plus the second year, 20x4, we have 320. We want to calculate depreciation on plant and equipment. So we have plant and equipment cost 10 million. Remember, of this 10 million, 2 million has been classified as held for sale. So we have 20% of 10 million minus 2 million, which was classified as held for sale. So that means you'll be left with 8 million of the cost, which was not classified as held for sale, minus, remember, since depreciation is to be calculated on the carrying amount, which is residual value method, how much was the accumulated depreciation on plant and equipment? Plant and equipment accumulated depreciation at 1st of January 2SS5, 3.6 million. 3.6 million. Then, if 3.6 million is the accumulated depreciation at 1st of January 2SS5, how much is the accumulated depreciation on assets which was classified as held for sale as at that same date, which is 1st of January 2SS5? You know, in 2SS3, 400 was charged. In 2SS4, 320 was charged. That means 400 plus 320, that will be 720 minus 720. That is the accumulated depreciation as at 1st of January 2SS5. This 720 comprises 400 plus 320. That is how I got the 720. If you have, you know, this is 8 million. That is 10 million minus 2 million. That will be 8 million. Then 3.36 minus 720, that will be 2880. If you subtract 2880 from 8 million, you are left with here. You have 5120. Then what is 20% of that? Then you have 1024. 1024. That is the accumulated depreciation on the remaining asset. Why are we subtracting 2 million here? We want to get the remaining asset which was not reclassified. So that means of 10 million, 2 million has been classified as held for sale. 8 million was not classified as held for sale. So then of the accumulated depreciation, the whole depreciation on the entire asset is 3.6 million. Then we've calculated the one that relates to the asset held for sale. If you subtract the one on the asset held for sale, the remaining depreciation will be the depreciation that does not relate to asset that was classified as held for sale. So now, aside this depreciation for the year on plant and equipment held for sale. So before the criteria for held for sale were met, 192,000 depreciation was charged on that same asset. This 192 that was charged for 2SS5 will still form part of the expenses for the period. So we have 192. So ordinarily, depreciation will have been 1024 plus 192. That means the total depreciation will have been 1216. That is the sum of the two depreciation. The depreciation that will have been charged on the plant and equipment will be 1216. Now, let's go through the note 3. From note 3, it is the policy of Lease to recognize any foreign exchange difference as other income or other expenses as appropriate. So the items you have in note 3 has nothing to do with the cost of sales. Note 4. On 1st of November 2SS5, Lease entered into a 12-month contract to lease some additional warehouse space to meet short-term capacity use. Lease directors elected to account for this as a short-term lease in accordance with IFRS 16 leases. The lease agreement requires a payment of 720,000 euro on 1st of November 2SS5 and on 1st of May 2SS6. The 1st of November 2SS5 payment was charged to cost of sales. Now, if you look at this lease, it's a short-term lease. In accordance with the provisions in IFRS 16, a short-term lease should be accounted for on a straight line basis. Then the lease payment should be spread over the lease period. And the lease period is a period of 12 months. That means the installment is supposed to be charged, is supposed to be expensed over 12 months period. But look at this question. One is payable in November 1st, and the other one was payable on the 1st of May 20XX. So it means the two payments does not fall within the same year. No, the accounting year in question is 2SS5, but the second installment does not fall within 2SS5 accounting period. So if you sum up the two installments, it is 720,000 plus 720,000, the one for November 1st and the other one for May 1st, giving us 1,440,000. The amount that is supposed to be expensed, and we were told the 720,000 which was paid first on November 1st has been included in the cost of sales. So if you want to go by the principle, the 1,440,000 is supposed to be expensed over 12 months period. So if it is to be expensed over 12 months period and only 720,000 has been included in the cost of sales, and the installments, now let me have working number 2. Working number 2, lease rental euro 1,000 of euro amount included in cost of sales. We were told 720,000 have been included in the cost of sales, the first installments, which was paid on the November 1st. Now, amount due for the year. Due for the year. Remember, the first installment was paid on November 1st. So, and the year end is December 31st. That is to show that only 2 months installments are supposed to be included in the cost of sales. That is the installments for November 2SS5 and December 2SS5. But 720,000 have been included in the cost of sales. Therefore, amount supposed to be included in the cost of sales will be 2 months out of 12 months period times 7 and times 1,440,000. No, the 2 years installment. The first installment on November 1st, 720,000. The other one on May 1st, another 720,000, giving us 1,440,000. So 1,440,000 times 2 divided by 12. That gives us 240,000. The amount that is supposed to be charged to cost of sales is 240,000. Now, 720,000 have been included in the cost of sales. That means the rest were paid in advance. If you subtract 240,000 from 720,000, so how much was paid in advance? 480,000. 480,000 was paid in advance. So we have advance payment. This advance payment will need to be removed from cost of sales. Why? Because 720,000 have been included in the cost of sales. 720,000 have been included in this cost of sales, and the amount that's supposed to be there is supposed to be 240,000. So we remove the advance payment. So we have advance payment. Working number 3. Working number 2. Advance payment of 480,000 will be subtracted from cost of sales. So after this now, then we have note 5 and note 6. Note 5 and note 6 has nothing to do with the cost of sales. So how much will be the cost of sales now? That will be included in the statement of profit or loss. 28,280 plus 1024 plus 192 minus 480. That gives us 29,016. 29,016. 16. So the cost of sales amounted to 29,016. 29,016. If you subtract the cost of sales from revenue, you arrive at the gross profit. How much is our gross profit now? So subtracting from 46,960. So we have the gross profit of 17,944. 17,944. 17,944. After gross profit, we have distribution cost, 3,630. Distribution cost, since there is no adjustment or items in the note that will affect this, so we will write that amount directly, 3,630. After distribution cost, we have administrative expenses. Administrative expenses. Let's have that as note. Administrative expenses, that is note 2. Note 2. Note 2. Administrative expenses. Administrative expenses. So amount is in €1,000. So the starting point is the administrative expenses, admin expense as per trial balance. Now, in the trial balance, we have administrative expenses of 6,080. 6080. Let's go through the outstanding items in order to ascertain which of the items in the note we have a bearing on the administrative expense. Note 5. On 1st of January 20SS5, Leland granted 40,000 shares appreciation rights to each of its 8 directors. Conditional in each case on the director working for Leland until 31st of December 20SS7. Each share appreciation right had a fair value of €5.40 on 1st of January 20SS5 and €6.50 on 31st of December 20SS5. Remember, the year end of Leland under consideration is December 31st, 20SS5. Leland initially estimates that 7 of these 8 directors will still be working for Leland on 31st December 20SS7. So the one we need is 20SS5, not 20SS7 yet. They've estimated that 7 of the 8 directors will still be working for Leland on December 20SS7, but adjusted the estimate to 6 directors at December 20SS5. So it means 6 directors will be used for 20SS5, the year end, the year under consideration. So none of the directors had left by 31st December 20SS5. Leland accounting policy is to recognize share-based expenses in administrative expenses. You are to recognize share-based expenses in administrative expenses. That is why we are going to adjust for that in administrative expenses. So now, remember, you were told at December 20SS5, 6 directors, you were told, but adjusted the estimate to 6 directors at December 20SS5. So that means 6 directors will be used. So now let's have adjustment for share-based payments now in 2SS5. Share, let me say working number 5, working 3, working number 3, share-based payment. Share-based payment. So if you want to recognize liability, the amount is in thousand euro. So no liability will be recognized on the 1st of January 2025. Therefore, this figure will not be used. So, but as at the year end, then you will recognize a liability to the tune of the fair value as at the year end. So the liability now, that is 2xx5. So as at December 31st, so you want to recognize liability. Liability that will be recognized, 40,000 share appreciation rights. You have 40,000 times. Now, those that meet the vesting condition as at December 2005 are 6 directors. 6 directors at 31st December 2005. So we have times 6 times what is the market value as at that date? The January, this 5.4 is for January 2005, and the one as at December 2005 is 6.5 times 6.5 euro times. Now, for how many years? The condition is 8 director. Conditional in each case on the directors working for Lease until 31st December 2007. Let's count from 2005, January to December 2007. How many years? December 2005, that is 1 year. SS is 2 years. SS7, 3 years. So that means we have 3 years involved. Times 1 out of 3 years. So December 2005 is the first year under consideration. So that is why we have year 1 out of 3 years. 40,000 times 6 times 6.5 divided by 3. That gives us 520,000. 520,000. Then amount that will be charged as expense for that year will equally be 520,000. So it means we will debit the expenses with 520 and credit liability with 520. So administrative expenses. So we have share-based payment expense, and that amounted to 520,000. Now, since there are no further adjustment or no other item that requires adjustment in administrative expenses, we can sum up that. So you get 6,600 as the total. 6,600. This 6,600 will be recognized as an administrative expenses in 2SS5. So our administrative expenses amounted to 6,600. After the administrative expenses, we have other expenses. Other expenses. Let's have that as note 3. Other expenses. We have other expenses as per trial balance. Other expenses as per trial balance. The amount we have as other expenses in trial balance amounted to 1,390,000. 1,390,000. We have impairment of plant and equipment, which is to be classified as held for sale in accordance with the provisions in IFRS 5. Let's have that as working number 3. Plant and equipment. Plant and equipment held for sale. The carrying amount of this plant and equipment has been measured from working 1, carrying amount. From working 1, the carrying amount of the plant and equipment, which is to be reclassified as held for sale, amounted to 1088. Now, you are given the fair value less cost to sell. If the carrying amount is 1088, fair value less cost to sell. Fair value less cost to sell. That is the net realizable value. Net realizable value. From note 2, you were told that plant and equipment with an original cost of 2 million as a non-current asset held for sale. At that date, the fair value of underperforming plant and equipment was estimated as 900,000 euro and selling cost estimated at 200,000 euro. Therefore, the net realizable value will be 900,000 minus 200,000, giving us 700,000. We have 900,000 minus 200,000 euro. That gives us 700,000. If you subtract the 700,000 from the carrying amount of 1,088,000, then you have impairment loss of 388. 388. So that is the impairment loss. Impairment loss of 388. So this impairment loss will be included in other expenses. Impairment of non-current asset held for sale. That is working number 3. Working 3, and we got 388. 388. We have depreciation on land and building, which is to be charged to other expenses. Let's have that as working number 4. Working number 4. So we have schedule of property, plant, and equipment. And the property, plant, and equipment we have include land, building, and plant and equipment. These are the PPE we have in the question. Amount is in 1,000 euro. So, the first thing is the opening balance, which is at cost. So we have land, 12,200. 12,200. That is the cost of the land. The cost of the building, 17,600. 17,600. And that of plant and equipment, the cost is 10,000. Plant and equipment, we have 10,000. We have the reclassification. The plant and equipment which was reclassified as held for sale in note 2, additional information number 2. So, and you were told that amounted to 2 million from additional information number 2. So, it's to be reclassified as held for sale. There is no addition nor disposal. You were told in note 2, no addition nor disposal of property, plant, and equipment during the year. So, what will be the balance now? So, you have 12,200, 17,600, and 8,000. So, that is balance. This balance is at cost. After the balance, let's have this as A. Then we have depreciation. The opening balance. How much is the accumulated depreciation in respect of this asset? So back to the trial balance. We have the accumulated depreciation for buildings, 440. Plant and equipment, 3,600. So building is 440, while that of plant and equipment is 3,600. 440, 3,600. Remember, land is not a depreciable asset. After this, you have the depreciation charge for the year. Charge for the year. Remember, a straight line method is to be used in depreciating the building, and reducing balance method is to be used in depreciating plant and equipment. And we've calculated the depreciation on plant and equipment, which have been included in cost of sales according to the requirements of the question. Linen applies the revaluation model to its land and buildings. The revaluation surplus in the trial balance relates to the last revaluation of land and buildings net of deferred tax of 15%. This revaluation took place on 31st of December 2003. The last revaluation took place on December 2003 when the building were assessed to have a remaining useful life of 40 years. So the remaining useful life of building is 40 years. So at 31st December 2005, the land and building were professionally assessed to have a fair value of 32 million. So the remaining life of the building is 40 years. Therefore, if you want to calculate the depreciation on the building, so how much is the value of the building? 17,600. 17,600 divided by 40. 17.6 million divided by 40. That gives us 440,000. So this gives us 440,000. Depreciation charge for the year, 440,000. This 440,000 is 17,600. The 440,000 here is 17,600, 17.6 million. This is 17.6 million divided by 40 years. So that gives us 440,000. So that is how I got this 440. But this one is in the trial balance. Then the the depreciation charge for the year in respect of plant and equipment, it is totaled. You know, we got, if you look at the working from cost of sales, one of the depreciation is 1024 and the other one is 192. So the total is 1024 plus 192. That gives us 1216. Go to cost of sales for this one. If you go to cost of sales, you will see this two value there. So the addition is 1216. That is the depreciation charge for the year. Then reclassification. The asset which was reclassified as held for sale. How much is the accumulated depreciation of that asset held for sale? Remember the first year, if you go back to our workings on the asset classified as held for sale, the first year we got 400 as depreciation. The second year we got 320, and the third year we got 192. And it is this 192 that was included in the depreciation charge for the year. So that is how we got this 192. So if you sum up this, how much is the accumulated depreciation on asset classified as held for sale? So if you sum up these three values, you got 912. So you have to remove that since the asset has been reclassified. So how much is the accumulated depreciation on this asset? So the accumulated depreciation now, accumulated depreciation, let's have this as B. So here is N, this is 880, and this is 3600 plus 1216 minus 912. That gives us 3904. If you subtract 3904 from 8000, we have 4096. Then 17600 minus 880. So this gives us 16720. Then 12200 minus N. So you still have 12,200. This is the carrying amount. Then you have to compare this sum with the revalued amount because it has been revalued during the year. So how much now is the depreciation that will be included in other expenses? So we have depreciation. Remember, you were told only the depreciation on the building is to be included in other expenses, not the entire depreciation. Depreciation on building. Now, if you go back to our working from working number 4, the depreciation to be spent during the year in respect of building, and that amounted to 440. This has been included in the cost of sales by virtue of the requirement of the question. We were told in the note 2, additional information number 2, that depreciation on the plant and equipment is to be charged to cost of sales, and that is why this has been included in the cost of sales. And this one, depreciation on building, is to be included in other expenses, you have been told. So now 440 depreciation will be included in other expenses. So we have 440. So if you now sum up this addition of these three items, since there are no further items to be adjusted in other expenses, we can sum them up. 1390 plus 388 plus 440. That gives us 2218. 2218. This is the amount that will be included in the statement of profit or loss as other expenses. 2218. Before we consider the finance cost, let's go through the item in the note 3. In order to ascertain if that item will be adjusted in other expenses or treated in other income, because you were told that it is the policy of linen to recognize any foreign exchange difference as other income or other expenses as appropriate. That means if it is exchange gains, then you treat it as other income. But if it is exchange loss or deficit, you treat it as other expenses. So let's check if this will be treated as other expenses or other income. Note 3. On 5th of December 2005, linen purchased inventory on credit from a new supplier who is located abroad for 5.8 million fiaris. The currency of the foreign supplier. Linen correctly recorded the transactions at the exchange rate on the date of purchase. Know the date of purchase is 5th of December. So that means the exchange rate on the 5th of December, which is 1 to 4 fair. So that means to translate it now, we have 5.8 million divided by 4. That will give you the amount recognized by linen. So which is 5.8 million divided by 4. That means linen has recognized 1,450,000 in the financial statement when it was translated initially. So at the reporting date, you have to remeasure it. You know, the reporting date is December 31st. You have to remeasure it to the current exchange rate of 5. So linen correctly recorded the transaction at the exchange rate on the date of purchase. The payable had not yet been settled at 31st December 2005. The amount hasn't been settled at the year end. And the goods remained in the warehouse of linen. Relevant exchange rates are, we have 5th of December 2005, 1 to 4. 31st of December 2005, 1 to 5. So now, since it was mailed at exchange rate at the date of purchase of 1 to 4, then at the year end, since the invoice have not yet been settled, then we have to remeasure it at the closing exchange rate, which is 1 to 5 at the reporting date. Note 4. Foreign exchange transaction. Remember, the transaction took place as at during the year 2SS5, December 5th. And the value is 5.8 million from note 3. 5.8 million. The exchange rate at the time of transaction is 1 to 4. So that gives us 5.8 million divided by 4. That gives us 1,450,000. For better understanding, watch my video on IAS 21. So how to translate all this have been explained in that video. So this is the exchange rate at the date of the transaction, and this is the translated amount. As at the year end, which is December 31st, the exchange rate now becomes 5. So we have divided by 5. 5.8 million. You know, this is payable. This is payables. So the payable as at the December 5th was 1,450,000. As at the year end now, how much is the payable? 5.8 million divided by 5. The payable has reduced to 1,160,000. That is the payable. Now, since the payable has reduced, that means the entity gains. So you have exchange gains. Exchange gains. And how much is the exchange gains? The difference. You have the exchange gains of 290,000. These 290,000 will be recognized as other income, not other expenses. If it is an exchange loss, the exchange loss will have been treated as part of other expenses. Since we now have exchange gains, so that means we can consider our finance costs. Our finance cost amounted to 200,000. So we have finance cost of 200,000. After the finance cost, we have exchange gains on foreign currency translation. We change the exchange gains to other income. After other income, we sum up all these items. That will give us the profit before tax, 17,944,000 plus minus 3,630,000 minus 6.6 million minus 2,218,000 minus 200,000 plus 290. So we have 5586. 5586. And this is profit before tax. Profit before tax. Then we now have income tax expense. Income tax expense. Let's have this as note 5. To calculate the tax expense, let's go to the note 6. At 31st December 2005, Lease determined that the carrying amount of its net asset after accounting for adjustments from the information above exceeds their tax base by 12.8 million. So the carrying amount exceeds the tax base. That is to show that this is a taxable temporary difference. And if you have watched my video on IAS 12, I've explained the taxable temporary difference where the carrying amount of an asset exceeds the tax base. And we said the taxable temporary difference will give rise to a deferred tax liability. So if you apply the tax rate on this temporary difference, the amount by which the carrying amount exceeds the tax base, which is a temporary difference, that will give us the deferred tax liability that will be recognized at the year end in the statement of financial position, with the exception of any deferred tax adjustments relating to revaluation of the land and buildings in the note 1. So you know there was a revaluation of land and building in the note 1. So the revaluation of land and building, which will equally give rise to a taxable temporary difference, were not part of these adjustments. So you were told except for that land and building in note 1. The remainder of the movement of the deferred tax liability should be reflected in the profit or loss. Linear tax rate is 15%. Linear tax rate is 15%. You were told the remainder, you have to adjust that in the profit or loss. So now, how much was that revaluation that took place in note 1? Let's go to the note 1 now. Note 1. From the note 1, you were told that Linear applies the revaluation models to its land and buildings. The revaluation surplus in the trial balance relates to the last revaluation of land and buildings net of deferred tax of 15%. This revaluation took place on December 2003. So the revaluation you have in the trial balance, that it was the previous revaluation that has happened. So not the one that just happened during the year. And you were told it was net of deferred tax. That means the deferred tax have been deducted from the previous revaluation. That is why you'll be having an opening balance in respect of deferred tax in the trial balance. Now, this revaluation took place on 31st December 2003 when the buildings were assessed to have a remaining useful life of 40 years. As at the date of the previous revaluation, you were told that the building was assessed to have a useful life of 40 years. That is why our subsequent depreciation was calculated based on 40 years. Remember, a straight line method of depreciation is required to be used for the building. So at 31st December 2005, the land and buildings were professionally assessed to have a fair value of 32 million, including 13.2 million in respect of land. So the value of land and building is 32 million, but of which land is 13.2 million. If you now subtract 13.2 million from 32 million, the remaining one will be the value of building. Now let's incorporate that in schedule of PP in order to calculate the amount of revaluation gains or loss that will be used to calculate the revaluation that will be adjusted and the deferred tax that will be adjusted in our subsequent tax computation. Note 5, we have income tax expense. Income tax expense. So we have, if you go to the profit or loss, you have income tax expense of 550,000. Income tax expense, income tax expense as per trial balance, and that amounted to 550,000. Then let's have working number 5. Working number 5, movement in deferred tax. Movement in deferred tax liability. Tax liability. The opening balance. This is opening balance in respect of deferred tax, and this will be given in the trial balance. Now, how much is the opening balance? We have deferred tax liability 1150. 1150. That is the amount given in the trial balance. 1150. Now, if you go through the note 6, you have the tax rate to be 15%. We have deferred tax that will be charged to other comprehensive income. From note 6, you are given a tax rate of 15%. Now we have revaluation gains of 1 million and 2,080,000. Then you now calculate 15% of that revaluations. 15% of 1 million plus 2,080,000. That will give us 3,080,000. 15% of that gives us 462. This deferred tax is the amount that will be recognized in other comprehensive income. If you now add it to 1150, then it increases to 1612. At the year end, you are given the temporary difference of 12.8 million. The amount by which the carrying amount exceeds the tax base, 12.8 million, and the tax rate of 15%. If you apply 15% of 12.8 million, that will give you the deferred tax at the year end. And that deferred tax at the year end is the amount that will be recognized in the statement of financial position under the non-current liability as deferred tax. Balance carried down, that is your deferred tax, 15% of 12.8 million. 15% of 12.8 million. That gives us 1,920,000. If you subtract it from 1612, then you have 308. So since the closing balance is greater, that means you have an increase in deferred tax. And remember, increase in deferred tax, increase in deferred tax will be added to the amount of tax expense in the statement of profit or loss. So we cannot have increase in deferred tax, that is working number 5, from working 5, that amounted to 308. If you add 308 to 550, then you have 858. That 858 is the amount of tax that will be expensed in the statement of profit or loss. 858. That is the tax expense. If you subtract 858 from 5586, then you have 4728. 4728. That is the profit for the year. Profit for the year. After profit for the year, the next item is the items of other comprehensive income. Other comprehensive income. And other comprehensive income, the only item of other comprehensive income that occurs during the year are gains on property, revaluation. And this gain was obtained from working number 4. Of course, that same gains have been used in the calculation of the amount of tax that will be expensed. The moment in deferred tax, 1,002,080,000. 1 million plus 2,080,000. So we have the gains of 3,080,000. We said of this, we have the tax that will be offset, tax offset of 462,000. So that tax will be deducted. Tax offset of 462,000. So if you subtract 462,000 from 3,080,000, then you have 3,080,000 minus 462, then you have 2,618,000. 2,618,000. That is other comprehensive income net of tax. Other comprehensive income, C income, net of tax. So if you now add this other comprehensive income to the profit for the year of 4,728,000 plus 4,728, then you have 7,346,000. And this 7,346,000 represents the total comprehensive income for the year. That represents the total comprehensive income for the year. That is all about the statement of profit or loss and other comprehensive income. So let's add the statement of changes in equity, though the question did not ask us for that. For the purpose of statement of changes in equity, the equity components include ordinary share capital of 2 million euro. Take note of that. Share premium, 3,680,000 euro. Retained earnings at 1st of January 2005, 22,070,000 euro. Then revaluation surplus at 1st of January 2005, 1,070,000 euro. So we have how many components of equity? Share ordinary shares, 1, 2, 3, 4. These are the amounts involved. So we want to open a statement of changes in equity with the opening balances of 2 million, 3,680,000, 22,070,000, and 1,070,000. The name of the entity is Lease. Statement of changes in equity for the year ended 31st December 2x5. Remember, we said we have 4 components of equity. So we let rule 5 columns. 2, 3, 4, and 5. So the first item is ordinary share. Ordinary share. The second item is share premium. And the third one is retained earnings. Retained earnings. The fourth one is revaluation. Revaluation reserves. And the fifth, now we have the total. Our amount is in €1,000. So the starting point is the opening balance. Balance brought forward. This is obtained from the trial balance. The opening balance in respect of ordinary share is 2 million. Then we have share premium of 3,680,000. Then we have retained earnings of 22,070,000. Then we equally have revaluation surplus of 1,870,000. Now, let's sum up these items. Plus 22,070,000 plus 1,870. We have 29,620,000. So, from the statement of profit or loss and other comprehensive income, we have total comprehensive income. Total comprehensive income. Remember, there are 2 columns. So total comprehensive income, we have the profit for the year, and the profit for the year will be recorded or recognized in retained earnings column. Then we equally have revaluation reserves. The revaluation will be recorded in the revaluation column, while the total will be in the total column. Now back to the statement of profit or loss and other comprehensive income. From the statement of profit or loss, we have the profit for the year of 4,728,000 and gains on property revaluation net of tax of 2,618,000. So these 2 items will be recognized in the statement, or will be recorded or recognized in the statement of changes in equity. So in the statement of changes in equity, the profit for the year amounted to 4,728,000. And then the revaluation surplus net of tax, 2,618,000. And the total comprehensive income for the year is 7,346,000. There are no dividends paid during the year, no issue of shares. So that means there are no further items that requires adjustment or that needs to be recognized in the statement of changes in equity. So we can sum this up. So we have 2 million, 3,680,000. Then the sum of these 2 items, 22,070,000 plus 4,728,000. Then we have 26,798,000. Then 1870 plus 2618. This is total 4488. Then 29,620 plus 7346. And this is total 36,966. This is statement of changes in equity. It is the balances obtained from the statement of changes in equity that will appear in the equity section of the statement of financial position. We want to prepare the statement of financial position for linear. So linear statement of financial position as at 31st of December 2xx5. Amount is in €1,000. So we have assets. The first class of assets should include the non-current assets. Now, back to the trial balance. Our non-current assets include land, building, plant, and equipment. We have shown this as a working earlier in working number 4. Land, building, plant, and equipment. We have this in working number 4. We have shown earlier when we were preparing the statement of profit or loss and other comprehensive income. Back to working 4. So we have land at the revalued amount of 13.2 million, building 18.8 million, then plant and equipment 1496. So we want to include this amount in our statement of financial position. Land is 13.2 million. Building 18.8 million. Then we also have plant and equipment 4096. After this, let's go through our trial balance. In our trial balance, we have intangible assets 2900. Intangible assets or 2900. Aside the intangible assets, there are no other items that should form part of the non-current asset in the question. So let's sum up what we have there. 13.2 plus 18.8 plus 4096 plus 2900. So we have 38,996. 38,996. That is the total of our non-current assets. After non-current assets, we have current assets. Current assets. Our current assets include, we have inventories of 4120. Inventories 4120. That is the closing inventory, and that amount is obtained from the trial balance. Then aside the inventories, we have trade and other receivables. Trade and other receivables. I've rubbed up the earlier working. I can't remember the last working we had, but let me assume this is working 6. So working 6, and which is for trade and other receivables. So the starting point is the balance as per trial balance. In our trial balance, we have trade and other receivables of 3860. 3860. On 1st of November 2005, Linen entered a 12-month contract to lease some additional warehouse space to meet short-term capacity use. Linen directors elected to account for this as a short-term lease in accordance with IFRS 16 leases. The lease agreement requires a payment of $720,000 on November 1st, on 1st of November 2005, and on May 1st 2006. No, $720,000 on November 2005 and $720,000 on November 2006. $720,000 plus $720,000, that amounted to $1,440,000. So you were told the 1st November 2005 payment was charged to cost of sales. So it means the first $720,000 has been charged to cost of sales. But if it is recognized on a straight line in accordance with the requirement of IFRS 16, a short-term lease should be accounted for or should be spent on a systematic basis using straight line method. That is based on the requirement of IFRS 16. A short-term lease, you account for that using straight line method. Now, this lease payment, the total is 720,000 times 2, which is 1,440,000. It's supposed to be expensed over the 12 months period. So 12 months period. The 1,440,000 is supposed to be expensed over 12 months period. But the first payment was made on November. The lease agreement requires a payment of 720,000 on 1st of November 2005. Since the first payment was made on November 1st 2005, and the year end is December 2005, that means the only payment that's supposed to be charged in the 2005 financial statement is that of November and December, 2 months, and out of 12 months altogether. Out of 12 months, only 2 months supposed to be charged as an expense. But you were told the first payment of 720,000 have been included in cost of sales. Now let's check if the amount that have been charged to cost of sales, if it is appropriate. If you look at our earlier workings when we're calculating cost of sales, we know that it's not 720,000 that is supposed to be charged to cost of sales. Now we have amount charged as cost, amount charged to cost of sales, 720,000. 720,000 has been charged to cost of sales. Then amount due for the period, that is the amount that is supposed to be expensed for the period. Amount due for the period. Remember, I've told you only 2 months were due. The one for November and December. 2 out of 12 months times, the lease payment, 720,000 times 2. 720,000 times 2. Since one payment was made in November and the other one was made on May, which is 720,000 each, giving you 1,440,000. 1,440,000 times 2 divided by 12. So the amount due for the period is supposed to be 240,000. 240,000 is due for the period. But 720,000 was expense. That means the amount that is supposed to be expense is 240,000, but 720,000 was expense. So lease payment in advance now. Lease payment in advance. So the remaining ones is in advance. If you subtract 240,000 from 720,000, then the amount paid in advance is 480,000. If you add the 480,000 to 3,860,000, no, we normally charge payment in advance as an expense. So that is why this 480 is to be charged as an expense. Payment in advance, we used to recognize it as a current asset. So that is why we are adding it here. 4340. 4340. So that means trade other receivables now that's supposed to appear in the statement of financial position will be 4340. We also have cash and cash equivalents, 260. Cash and cash equivalent, 260. That should form part of our current assets. So if you sum up this item, 4120 plus 4340 plus 260, we have 8720. 8720. Then that is our current asset. Then we also have non-current asset held for sale. Non-current asset held for sale. Remember, you were given its fair value to be 900,000, and the cost to sell is given to be 200,000 from the additional information. 900,000 minus 200,000, we got 700,000. If you add the 700,000 to our current asset of 8720 plus 700, then you have 9420. So our current asset is totaled 9420. So that is total current assets. Then you now sum up the current and the non-current assets in order to get the total asset. Our non-current asset is totaled 38,996, while the current asset is totaled 9420. So if you sum them up, plus 38,996, so we have 48,416. 48,416. This is the total asset. Total assets. After our total assets, then you have equity and liabilities. So equity, all the amounts shown here will be are obtained from statement of changes in equity. Remember, we have prepared the statement of changes in equity earlier. So where we have ordinary share of 2 million, 2 million. Then from the same statement of changes in equity, we have share premium of 3680. Share premium 3680. Then same statement of changes in equity, retained earnings of 26,798. 26,798 was obtained. Then we also have revaluation reserve, revaluation reserve of 4488. 4488. And the total is 36,966. 36,966. So all these figures or amounts were obtained from our statement of changes in equity. This is our statement of changes in equity, and this is where all these figures were obtained from. Then After equity, we have the non-current liabilities. Non-current liabilities. Under non-current liabilities, we have long-term borrowings, 4 million. Long-term borrowings of 4 million. Then we also have deferred tax liability. You may go through our earlier workings. So you will see this amount there. Or if you go through the note 6, additional information, outstanding item number 6, you have the amount by which the carrying amount exceeds the tax base of 12.8 million. 12.8 million. This is given in outstanding item number 6. 15%. The tax rate of 15% is equally given there. If you calculate 15% of 12.8, you have 1,920,000. So this will appear as non-current liability, and the total will be 5,920. After non-current liability, then we have the current liabilities. As part of our current liabilities, we have trade and other payables, 4750. This requires adjustment. Then we currently have current tax payables, 550. This one does not require adjustment. So now let's include these items now in our statement of financial position. So we have current liabilities, which include trade and other payables. Let me have this as working number 7. Working number 7. Then we have current tax payables. This is given in the trial balance as 550,000. So now let's have our working 7 now. Working number 7, which is the working for trade and other payables. Trade and other payables. The starting point will be the amount as per trial balance. Amount as per trial balance. The trade and other payables given in the trial balance is 4750. 4750. Then we also have share-based payment. Share-based payment. This has been shown as an expense. Everything in accounting is usually done in line with the principles of double entry. The debit entry has been recognized as an expense, while the credit entry, which will be recognized as a liability, is what we want to show now. So remember the share-based payment that is given in the note 5. On 1st of January 2005, Lease granted 40,000 shares appreciation rights to each of its 8 directors. Conditional in each case on the directors working for Lease until 31st December 2007. Each share appreciation right had a fair value of 5.40 on 1st of January 2005. So at the beginning of the year, no liability should be recognized. And 6.50 on 31st December 2005. So this value will be used at the year end to recognize the liability. Note from 2005 to 2007, that is a period of 3 years, and all this have been explained earlier. Lease initially estimated that the 7 of these 8 directors will still be working for Lease on 31st December 2007. No, the year end is 2SS5, not 2SS7. But adjusted the estimate to 6 directors at 31 December 2SS5. So 6 directors at December 2SS5. So it means we are going to work with these 6 directors now. Share-based payment liabilities will be 40,000 times 6 directors times 6.5 times 1/3. So that is the amount that will be recognized as liability at the end of 2SS5. 40,000 times 6 times 6.5 times 1 divided by 3. That gives us 520,000. If you add this to this, then aside this, we have exchange gains. Exchange gains on foreign exchange transaction. This exchange gains has been credited to statement of profit or loss. The corresponding entry will be debited to liability. To debit the liabilities with that sum, it means you are subtracting it. So that is why we subtracted the 290, which represents the exchange gains for the period. 4750 plus 520 minus 290, that gives us 4980. 4980. So other trade and other payables, we have 4980. If you add this, how much is the total? If you add it to the 550, so the current liability is total 5530. That is our current liabilities. These current liabilities will be added to the equity and the non-current liabilities. Our total equity is 36966, and our non-current liability is 5920. If you add it to the current liabilities plus 36966 plus 5920, so we have 48416. The 416 is the total equity and the liabilities. 48416. That is the total equity and liabilities. Total equity and liabilities. If you compare this with the total asset, our total asset is 48416. You will see that the total asset is the same with the total equity and liabilities. So this marked the end of the solution to the question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA.